what's up? Red Panda Anthem. Red Panda, what's good?
So 125 basis points or 1.25% of additional rate hikes between now and say the spring of next year. And then the Fed holds there. Now, just to be fair, these forecasts are almost always certainly wrong, but it is the consensus right now of where people are trading. If there's going to be good news on inflation, if the inflation comes down faster, if the economy slows more quickly than is expected, then the Fed can back off sooner and do less damage to the economy. So I think I love what you guys were doing at the top of the show, which is talking about individual companies and earnings and this story and that story. And that's really important. But right now, a lot of the investing right now is a big macro story based upon the Fed and trying to figure out the direction of inflation. I mean, the answer to all the questions you guys are asking, the direction of inflation, how high the Fed has to go, how much damage that does to the economy, how much the damage to the economy does to corporate earnings, and how much all that does to unemployment. So these are the big questions, and these are the big, what you would call, I guess, beta things, the things that move all stocks together. Within that, as you guys discussed, there are individual stories. There's crypto and Apple, and there's GM, and there's Tesla, and there's Rivian, and there's a lot of great stories out there. But this big macro question, I hope to not be so busy next year. I guess I could tell you that. I hope that what I say and do is not as significant for the movement of the market as it is right now. But that's unfortunately not the case for at least to the end of the year.
I have to ask because, of course, it could be a lot worse. I graduated high school in 2000, so I think at that time the Fed fund rate was like 6.5%. In '89 it was 9%. You don't think we will go that high, do you, before things start to turn around? And I just want to be completely honest. The job that the central banks have is an incredibly tough one. So I want to be fair in that regard, but I do want to give our listeners a chance to brace. If we do push to 4.5 and that isn't enough, how high do you think we can end up going?
Well, I mean, I think the Fed will go where it needs to go to get the job done. I think that of all the bets I would take, I would not bet against the Fed not solving the inflation problem. Does that make sense?
Yes.
I think the Fed wins that game. And the question is, how ugly does it win it? If you know what I'm saying. How much damage does it do to the economy in the process? And the Fed, I mean, could go to 6% or 6.5%. But before you take that cyanide pill or whatever it is you were going to do there, just everybody relax a little bit.
Let me have some absinthe right now. Hold on.
So the thing is that I still think that some of the forces in the world that gave us a sustained period of low inflation, they're still out there, but they need to be able to assert themselves in the kind of more post-pandemic world, like getting China back up and running, right? Globalization was a very big and important factor that kept prices down. I know that's maybe a controversial topic in America, but the reason you're able to go to Walmart and Costco and all those places and get inexpensive things was in part because they were made in China, where things were made more cheaply. Apple is still making a good percentage of its iPhone product over there. And we have been in a sort of deglobalizing world where we have begun to be concerned about things like where stuff is made, where it's come from. You guys talked earlier about the Ukraine war and how much that is affecting prices. You know, those things work out. The supply chain problems work out. You start to get inventory back into the car lots and in the back rooms of places, and then you can have a more normal pricing environment. So I don't think that stuff's gone away. I think over time this will heal itself with the help of the Fed raising interest rates, but I don't think the Fed's going to have to go quite that far to solve this problem, because the other thing that's happening is a lot of the money that was given to folks in the post to help them through the pandemic, some of that savings is winding down, and that's going to also help reduce the rate of inflation.
You spoke about the pound. We can kind of double back on that. We're headed to London, Royal Albert Hall. We have a show there, and we have a lot of support in the UK. So, yeah, the dollar dropped, the pound dropped, but it's rallied. So,
yeah.
What are your thoughts on that? Why did it rebound, and what are your thoughts on the UK, what they're doing?
So I'm just going to call up the chart because I was just looking at that earlier. The pound rebounded, I think it was today, right? And that's because the Truss government, the new government over there, backed off their kind of crazy kind of profligate comments of doing all this amazing deficit spending and tax cuts. I think that's what happened. And by the way, I think that part of what happened when England said something is the bond trader said, well, wait a second, how great is the US on this score in terms of controlling its own spending? And so there was that question as to whether or not the fiscal side was going to be helpful or hurtful to the monetary side. And I hope people understand those are two separate things. The things the central bank decides, the Fed, is independent of what Congress and the president decide when it comes to spending. They all end up as inflationary in the economy, but those are separate decisions that are made. And so that's why the pound rebounded. The question I just have to ask you guys is, did you plan this trip before the pound crashed or after? Because that's like the smartest thing you could do with your money is go to England right now.
You know what's so crazy that you say that? It's divine intervention.
Worked out well.
And I just put that on Instagram. I'm like, if you've never been to England, this is the time to go. For all the tourists in America, I mean,
good time to be there.
I mean,
my wife is going. My wife's going next week. She had a trip planned months ago with her sister. They're going on one of those Jane Eyre tours, like all those old villages and stuff like that she's been wanting to do for her whole life. So she's going over there. And I'm like, sweetheart, you make the best financial decisions in this family all the time. I'm supposed to be the expert. And like the things that she's decided to do over the years, that's why we have any money at all.
You're a smart man.
Yeah.
Can we I want to talk about something that and if we a lot of our guests and us included watch CNBC pretty regularly, and we always see Treasury yields. So can you talk about what they are and the factors that affect them? Like we always hear and see 2-year, 5-year, 10-year, 30-year. Can you talk about what they are and again the factors that play a role in them and affecting them?
So it's a great question, and I love answering it because a lot of sophisticated folks don't have any idea what goes into them. They think they do, but they don't. And I've spent a lifetime trying to understand it. And, maybe I'm a little closer than I was before, but there's still a lot to learn here. So the deal is Treasury yield is the amount of interest that you get, obviously, for owning the bond. Well, what goes into that? You can kind of answer that question by asking yourself, what would you charge somebody to give them money and get paid back next year, get paid back in 3 years, get paid back in 5 years, or get paid back in 10? Yeah. So what does that tell you? What is an interest rate? An interest rate is the price that you get for foregoing or not consuming your money today. Right? So if I got $100 in my pocket and I give you $100, what do I want from you so I don't spend that money today? Now, I'm going to want to be covered by inflation in the first instance, right? So that means that there is what they call an inflation premium inside of it. I'm going to want to be covered for the risk of you not paying me back. So that's the second thing inside of it. Now, what is that risk with the US government? Technically, we call the Treasury the risk-free rate. In other words, there's no risk that the government is not going to pay me back. We can talk about that separately at another time if you want, but generally that's how the Treasury is viewed, as the risk-free rate. Okay, there's one other thing. Well, there's a bunch of other things inside, but another main thing inside is what they call the term premium, which is how long am I going to have to forego that spending for? So that I would do 1 year, well, I'll charge you one rate. But if it's 3 years, I'm going to charge you a higher rate.
Mhm.
5 years is a higher rate than that, and 10 years is an even rate higher than that. So what did I just do? I just did you an air chart of the slope of the yield curve. It goes 1, 3, 5, 7, 10, 20, 30, and it should go up like this. That's not the case right now. Right now, we have what's called a bunch of inversions inside the chart, and I'll tell you what those inversions are. What's an inversion? When a later dated treasury is yielding less than a current one. So I'll give you an example of that so you can understand it. Right now, the 10-year is 366, but the 2-year is 4.13. So the 10-year is actually yielding less than the 2-year. Why is that? Because it's telling you a story of what's going on. What that's telling you is people think that the Fed is going to hike rates to a certain level over the next 2 years. But over time, that yield's going to come down because there might be a recession or because the Fed ends up solving the inflation problem and cutting rates. So right now we're in this weird inversion time. And when you guys talk about recession, one of the things that has been over time a pretty good signal of recession coming is an inversion of the yield curve.
Yeah.
Have I confused you all or
No, keep going.
no?
This is amazing.
Yeah, perfect sense.
Okay.
Economics class all
Yeah,
over again.
This is high level.
Economics class.
Thanks.
Like studying for the CFP all over again.
All right, there's going to be an exam at the end of this, okay?
Yes. Yes.
And when you're talking about the inversion, you're referring to the 2 and the 10 for the audience, correct?
Exactly. And there's other inversions that I follow a little more carefully, which is I like the 2-year and which is not inverted. I like the 3-month and the 2-year, which is not inverted yet. That's the one the Fed follows, and that's one of the reasons why the Fed is not sort of conceding that there's going to be a recession. So the 3-month is trading at 339, the 2-year at 413. So that's another that's not inverted. But the 2-year is higher than the 5-year, it's higher than the 7-year, it's higher than the whole spectrum of yields out there right now. This is not normal. As I explained, the capitalist approach is I want more for lending to you for longer, in part because another thing is the risk premium goes up. In other words, you think about it, if I lend it to you for a year, well, you can pay me back next year, but I don't know what your situation is going to be 5 years from now. So I'm going to take a higher risk premium. So the world normal slope of the curve is like this. The longer you lend money, the more you should get for lending it for the length of time.
This that Red Panda Anthem. Ian, what's up? This that Red Panda Anthem. Red Panda, what's good? Red